In Lesson 5.1b, we'll be looking at what we know about the efficiency of the markets and how this translates to how we look at the markets, how we analyze the markets. There are some different types of analysis that can be done, and the analysis that you do really depends on how efficient you think the markets are. So we'll take a look at these different types of analysis and how our view of market efficiency will impact the type of analysis that we'll do. One type of analysis is called technical analysis, and this type of analysis really is diametrically opposed to the notion of the efficient markets. If the markets are efficient, it means that all of the past information has been reflected in the current stock price. So there would be no point in looking at past prices to look for patterns in the past price history, because there would be none. Everything would already have been taken into consideration in the current price. So someone who performs technical analysis, that person could be called a technician or a chartist, they really don't believe in the efficiency of the markets. They believe that if you look at the past price movements and if you plot those and chart those price movements along with the current price movements, you'll be able to discern a pattern that will tell you what's going to be happening in that stock in the future, and it will tell you when you should buy and sell that stock. The other type of analysis that can be engaged in is something called fundamental analysis, and this type of analysis does agree to some extent with some of the efficiency of the markets, but someone who performs fundamental analysis doesn't believe that all stocks are priced completely efficiently at all times, because you're performing the analysis in order to identify stocks that maybe are not priced correctly, that are underpriced, and you can buy them thinking that the value is going to go up to meet its actual potential value. So when fundamental analysis is done, the analyst takes a look at what earnings the company has had, how much dividend they've paid, and what they expect to be paying in the future, what will be happening to the economy in the future and how that will affect the stock. Also, they'll look at the company's balance sheets to determine their liquidity and their debt structure and how efficient their operations are, all at the same time as looking at the entire economy, where it's headed, and where the industry in which the company deals is headed. A very well-run company would have a hard time performing very well in an industry that is on its way out. So all of these things have to be taken into consideration. If you believe that the markets are completely efficient, then neither technical analysis nor fundamental analysis would have any value, because no price patterns would be able to be discerned. So technical analysis would have no value, and current stock values would be exactly what they're supposed to be. So fundamental analysis would have no value. There'd be no point in doing it because you wouldn't identify anything that was undervalued. In reality, the value of fundamental analysis really comes into play when you're dealing with large amounts of money. There's a lot of competition to get the best information and to analyze it in the most efficient way. And really what happens is the people who are able to identify those mispricings of securities are the ones that can do a better analysis of the information than others and can determine the appropriate value better than other people can. Now, all of this has implication for us as investment advisors, because when we are dealing with clients' investment portfolios, there are a couple of different types of management of those portfolios that can be engaged in. Active management is management where we're trying to beat the market with the portfolio that we've identified for our clients. So we're trying to do better than the market has done by choosing better investments than the average investment. A passive portfolio investment style or management style really doesn't try to do that. A passive style says, well, things are really priced pretty appropriately, so there's really not much point in trying to beat the market. I'm just going to choose good stocks, good investments, and hold them and let them do their work. So whether you believe in a very large degree of efficiency or a small degree of efficiency in the market will determine whether you believe that portfolios should be actively or passively managed. And basically on this slide I'm just again stating some of the information that I alluded to on the previous slide, that basically the degree of management that you're going to engage in will depend on your view of efficiency, and that the portfolios that will benefit the most from the active management are the larger portfolios, because the amount of mispricing that can be identified is often very small, so you have to have large amounts of the stock in order to really have any benefit from that.